bull market can make an average or even rookie investor feel smarter than a Wall Street or Bay Street vet. First-time investors are throwing darts at a board blindfolded and coming up with big winners. I'm seeing it everywhere. They're putting their stimulus check to work in Robinhood, getting free stock for signing up and watching their stonks rise. The thrill of big gains in stocks is juicing the loins of a whole new generation of traders and investors. If TikTok is any indicator, there has been an explosive growth in accounts picking stocks and predicting which will rise. A couple even went viral with a video showing a surefire way to make money. You're looking at the snapshot and the quote of these individuals. More evidence of how the hype from these TikTok investors influencing the markets can be seen in how small caps have been performing relative to the rest of the markets in the last 3 months. So we decided to put together the S&P 500, those were the big stocks, versus the S&P 600 small stocks, that's the red line. So you can see that both are doing quite well considering since the election. But look at the red, how it's significantly outperformed the S&P 500. Now, why is that? Big wins on penny stocks are the dream of any wannabe investor, and the surge of interest in capital has led to irrational exuberance in buying small cap junior companies. Let's just say that if it were that easy, you probably wouldn't be reading this right now. The wall of worry. One of the key concerns for me that I believe could be a catalyst for a market correction is in the bond market. Over the next 5 years, a significant portion of the lowest investment grade rated bonds, BBB, along with the high yield or what's called the junk bonds rated below BBB, will mature. Companies will have to either repay the capital, which they can't, or issue new debt to replace the existing debt. So who will buy it? The only way this will be mitigated is if the US Federal Reserve continues to expand its asset purchase program. It may have no other choice but to buy junk. That's what Japan has done over the last 15 years. But Japan doesn't have as much junk debt. It's also what we've seen happen in the natural resource industry as well. I've previously talked about extend and pretend, first in the oil patch and later in the gold mining sector. Back then, I called exactly what happened to the oil companies, where the worst ones went bankrupt, but the most managed to delay or refinance their debt. If we expect this to be the case again, we will have short windows of volatility and sharp corrections until the Fed moves quickly enough to backstop the bond market. Then our game plan will be to do exactly what we did in March 2020, which played out exceptionally well for me and my subscribers. However, this time, I promise to try not to be too cheap. Bond whispers. The Russell 3000 index is an index composed of the 3,000 largest publicly listed US companies. It is one of the most all-encompassing index, and it includes companies with trillion-dollar market caps all the way down to $200 million market caps. This provides a solid barometer of the required refinancing or corporate debt in the US. What you're looking at right now is a chart which shows the total debt by maturity year for companies in the Russell 3000 index. There is a wall of debt maturing in the next few years. And the next chart you're looking at is the high yield debt. Remember, that's the junk bonds maturing in the coming years. Again, there's incredible amounts of debt coming in the next few years. The combined corporate debt wall between the BBB and the junk could be a catalyst for a future major market correction. You can see that the previous years shaded in gray are about half the size of the upcoming maturities. Where it gets interesting is that on average, companies in the Russell 3000 today have far more debt relative to earnings than the historical levels. This debt wall isn't the only thing that's on my radar, however. The Buffett indicator is sounding a major alarm. Warren Buffett has gone on a money-making spree in 2020. Backing big winners like Snowflake and trimming positions for a profit, Buffett knows quite well that it's not a gain until you sell. Last week, we also detailed how Buffett's right-hand man for half a century, one of my favorite market guys is Charlie Munger, said that stocks will remain flat for the coming years. Two of the most famous investors in history might have had their simple Buffett indicator to give them a warning. For those of you who aren't aware, the Buffett indicator is simply the total market cap of all US stocks divided by the US national GDP. In other words, it shows the historical valuation of the markets relative to the strength of the economy that these companies are built upon. But let me make your life easy. Why don't I just chart it out for you here? That's exactly what you're looking at right now is the Buffett indicator. This is the US stock market divided by the US GDP. Now, let me explain. The blue line is that ratio. And then I laid this out is in standard deviations. As you can see, the Buffett indicator alone doesn't tell the whole story, but we are at extreme range right now. You need to be paying attention to this. Given the zero or even negative interest rate environments globally we find ourselves in, it only makes sense that people would look for the returns on the stock markets instead. Still, it's undeniable that there continues to be a significant disconnect between the hype in the stock markets and the state of the economy right now. How to protect yourself in a correction. Look, I'm not trying to be a worry Nelly here, but what I am trying to prepare everybody for is locking in massive profits, which we've done. And between the unfounded optimism in the small caps, the oncoming debt wall of worry, the Buffett indicator and other signals telling us we need to be cautious, and even market correction seems more and more likely with each passing day, you need to prepare for that risk. I showed in last week's article, gold stocks have sold off during past market corrections, and it'll happen again when the overall market sell off. Oil stocks will also get hit, so we need to think about protecting ourselves against these declines. The volatility index, known as the VIX, VIX, is a useful tool which we can use to buy protection. The volatility index is a forward-looking index which is derived from the S&P 500 option pricing. As market turmoil increases, the volatility index increases. And as the turmoil subsides, the VIX decreases. What you're looking at right now is the chart of the VIX since 2005. You'll see the largest spikes were the 2008 financial crisis and then in March of 2020 as the pandemic took hold. Now, you can't buy the VIX itself, but there are investment products which reflect in the broadest sense the same type of movement. These can provide the protection we're looking for. The most well-known and actively traded instrument which reflects the VIX is the exchange traded note VXX. VXX is an investment product created by Barclays, a major European financial institution. Now, you need to be particularly careful on timing of the VXX for several reasons. As the market goes higher, the VXX will trend lower. Due to its construction, the VXX mathematically could go to zero if there's never any future volatility, though this is highly unlikely. Also, this type of hedge is for active traders only. You can literally miss your payoff if you're even one day late, even by a few hours. I do not recommend going this route for almost all of my readers, except perhaps the ones who are glued to their screens 24/7 as active traders. And I do have many active fund managers and family offices that follow my stuff. Life is too short to bother with that, in my opinion. However, for those who are active traders, why would you buy something that could mathematically go to zero? Using a small percentage of a total overall portfolio, VXX has the capability to offset a substantial portion of unrealized and realized losses that could occur if we had another sharp correction. For the rest of you who aren't active day traders, however, you can take a look at how I'm planning to protect myself and my subscribers' portfolio by signing up to my newsletter, the Katusa Resource Opportunities. You'll be able to see exactly what I'm holding in my own portfolio and what price I paid for each position. Most importantly, you'll see how I just laid out scenarios to protect your portfolio for as much as 30% downside with a 1% cost of your portfolio. That's smart hedging. You'll see how I'm planning not just to survive, but profit when this market sentiment bubble pops, which it will. Now look, our channel has grown tremendously in the past year, and we'd like to thank our viewers on YouTube by announcing the Katusa Fellowship, where I'll be giving away 2 annual subscriptions valued at $3,500 per year of my premium research to our YouTube audience. All you have to do is click on the link in the description below to register for the Katusa Fellowship. Stay safe.